Welcome, class, to today's Explainer. I'm your market analyst for today, and we're going to absolutely demystify Bitcoin's program volatility. If you've ever found yourself wondering why the crypto market seems to just ride these massive, totally predictable waves of boom and bust, well, you're in exactly the right place. We're going to pop the hood on Bitcoin's code and really get into this fascinating economic engine known as the halving.
Okay, let's take a quick look at today's syllabus. We're going to cover the core halving mechanism, the anatomy of the four-year cycle, historical halving data, reading the rainbow chart, minor economics, and finally, the new institutional era.
Section 1. The core halving mechanism. Let's start our lecture right here by understanding the fundamental engine that actually drives Bitcoin's scarcity.
So the absolute crucial point here is that this mechanism acts as a programmatic defense against inflation. It's a hard contrast to traditional fiat currencies, right, like US dollars or euros, because central banks, well, they can basically print an infinite amount of paper money whenever they feel like it, which just slowly eats away at your purchasing power. But Bitcoin's creator, Satoshi Nakamoto, hard-coded a completely different set of rules. Exactly every 210,000 blocks, which takes roughly 4 years to mine, the reward given to the computers securing the network is just literally sliced in half. And this keeps happening until all 21 million Bitcoins are mined, putting a hard, unbreakable cap on the total supply.
To put it simply, think about physical gold for a second. All the easy gold, the stuff just sitting near the surface, that was all mined up over a century ago. Today, getting gold requires these massive, wildly expensive operations digging miles underground. It literally gets harder and more resource-intensive as time goes on. Bitcoin mimics this physical scarcity perfectly, just digitally. It is an algorithmic version of resource depletion. The supply of new coins is programmatically squeezed, creating what economists call a structural supply shock.
Moving right along to Section 2, Anatomy of the Four-Year Cycle. Let's look at how this mathematical squeeze builds into a highly predictable psychological rhythm.
Now, what is really wild about this is how reliably human emotion cycles through these four distinct phases after every single supply shock. First up, the accumulation phase. This is the quiet, honestly kind of boring period where smart money and long-term believers just slowly buy up the asset at a massive discount. Next, bam, the bull market. The reduced supply from the halving actually hits the market, prices start rising, media hype kicks into overdrive, and retail FOMO, fear of missing out, drives prices to staggering new all-time highs. But, euphoria never lasts. That leads right into the bear market. It's a brutal phase. We're talking sharp corrections, often dropping 70 to 80%, filled with pure panic selling. Finally, we hit recovery. The weak hands are flushed out, the market stabilizes, and the stage is totally set for the next halving.
Section 3. Historical halving data. Let's dive right into the math and see the actual proof of these cycles in action.
If you look at the historical data, you can vividly see these dramatic price surges that reliably kick off roughly 12 to 18 months after the block reward gets slashed. Okay, check this out. In 2012, the reward dropped from 50 to 25 coins. Bitcoin was trading at just 12 bucks. Within a year, it surged over 8,000%. No joke. Then, in 2016, the reward halved again to 12.5 coins. And from a $650 baseline, it rocketed up almost 3,000%. Cut to 2020, right in the middle of the pandemic, the reward fell to 6.25 and the price eventually climbed from $8,500 to $69,000. And now, following our 2024 halving, the reward sits at just 3.125 Bitcoin per block.
But wait, you really need to observe this clear trend of diminishing returns here. We went from an 89x multiplier down to a 29x multiplier to an 8x multiplier. Why is that happening? Well, it's simple physics, really. As the asset matures and its total market cap swells into the trillions of dollars, it requires exponentially more capital to move the price. The percentage gains naturally have to become much more modest. It's like a puddle is super easy to splash, but an ocean, that takes a massive storm to move.
All right, Section 4, Reading the Rainbow Chart. To map all this historical data to actual market psychology, analysts love to use this incredibly popular model. So while this is basically just a visual guide overlaid on a logarithmic growth curve, mapping out these color zones really helps us visualize the emotional spectrum of investors. When the price action hits those dark red zones at the top, that signals maximum greed. The market is wildly overextended, and historically, that's your cue to take profits. The yellow bands right in the middle, those represent a balance market, kind of just a period to hold steady. But those dark blue zones down at the very bottom, that signifies maximum fear. Historically, when the crowd is totally terrified and selling everything, those blue zones highlight where Bitcoin is deeply undervalued, presenting basically the absolute strongest accumulation opportunity.
Which brings us to Section 5, Minor Economics. Now we're going to flip the perspective to the supply-side economics and actually look at the businesses minting this asset.
Class, I really want you to think about this for a second. If your salary was just slashed in half tomorrow, literally overnight, but your rent and your electricity bills stayed exactly the same, how in the world would your business stay afloat? Seriously, think about it. Because this is the absolute brutal reality that Bitcoin miners face every 4 single years.
3.125 Bitcoin. That is the current block reward as of the April 2024 halving. Let's put that into perspective. Before this event, the network was pumping out roughly 900 new Bitcoins every single day. Then, literally overnight, that daily production dropped instantly to just 450 coins. For a miner, their primary source of revenue is suddenly chopped in half, creating this incredibly intense margin compression.
So, to avoid total capitulation and bankruptcy, these miners have to adapt immediately. They aggressively pursue efficiency, constantly deploying the absolute latest, most energy-efficient ASIC hardware, which are basically just highly specialized mining supercomputers. But even more crucially, they have to lean hard on transaction fees. Actually, recent innovations like ordinal inscriptions, which are essentially digital artifacts or NFTs right on the Bitcoin network, have created these massive spikes in network activity. And that generates vital fee revenue to help bridge the gap left by the missing block rewards. The miners who just can't adapt, they are forced to sell off their equipment and shut their doors, leading to massive industry consolidation where literally only the strongest, leanest operations survive.
Finally, Section 6, the new institutional era. Let's dive into our last topic and examine how modern market dynamics are completely reshaping this classical theory.
We are currently witnessing a massive, undeniable paradigm shift. I mean, if you look back at the 2012 and 2016 cycles, the market was basically the Wild West. It was completely dominated by retail investors, tech enthusiasts, and those highly speculative ICO booms. But today, the landscape is completely transformed. We're now in an era driven by Wall Street spot ETFs, publicly traded corporate treasuries like MicroStrategy, just scooping up billions in Bitcoin. And incredibly, we're even seeing serious discussions about nation-states holding Bitcoin as a strategic reserve asset. It's a whole new ballgame.
Just look at the sheer scale of this. By early 2026, US spot ETFs had absorbed over 1.3 million Bitcoin. That is literally over 6.4% of the entire circulating supply. You have this unprecedented institutional demand competing directly against a newly halved, heavily restricted supply of only 450 new coins per day. It is an absolute economic pressure cooker of supply and demand.
So as Bitcoin creeps closer and closer to its 21 million cap, it begs the question, will the 4-year cycle actually survive all this institutionalization? Or are we witnessing the end of predictable volatility as we know it? Some analysts actually suggest this massive influx of traditional finance capital is going to smooth out the extreme booms and busts, potentially killing the 4-year cycle entirely. While others, they argue it's only going to amplify the coming supply shock into a massive so-called supercycle. I'm going to leave you with that provocative thought to chew on before our next class, because the data firmly suggests the rules of the game are fundamentally changing. Thank you so much for joining me for this explainer class. Keep studying those charts, and I will see you in the next one.